Typically, the bond market is supposed to be a pretty mellow place. Safe, stable. A place you know what to expect. But lately, it's been one wild ride. What the finpipe is going on exactly? The Federal Reserve started tightening monetary policy. Interest rates began to rise. And the all-important 10-year US Treasury bond yield rose above the crucial 3% mark. The thing you have to understand about bonds is that bond yields and prices are inversely related. Higher bond yields mean lower bond prices. Let's look at a price and yield graph of the 10-year US Treasury bond. This bond was issued at $100 in November 2017 to yield 2.3%. By March 29, 2018, its yield had risen to 2.75%, which saw its price drop to $95.83. Its yield finally increased above 3% on April 25, 2018, and its price had fallen to $93.58, down 6.4% since its issue 5 months earlier. So much for bonds as a safe investment. Things got even more interesting in May. Italy, which had an election in early March where two populist parties won the most seats, finally agreed on a coalition government. But they picked a finance minister who was on record as wanting to pull Italy out of the euro common currency. The waters of the financial markets reacted violently, sending US Treasury yields down sharply in a flight to safety. Our favorite Treasury bonds yield, which had peaked at 3.13%, dropped 0.33% to a low of 2.8% on May 29th. That popped its price up by 2.9% in 12 days. Recognizing the market's worries, Italy's president vetoed the choice of finance minister and opted for someone more suitable, calming down the waters of the financial markets if only temporarily. So, now that you know the truth about the bond market, you know that there's a lot more adventure in it than people think.
When the yields go up high with little left in the pie, that's the bond market.